Morning, everyone. So Derek and I just quickly run through the healthcare space, just tell you where we're positioning our calls at the moment. So basically, the first 9 months of this year, we saw the healthcare market underperform the ASX 200, but the last 3 months, it's traded broadly in line. If I just move to the next slide, this was the slide that we put up when we did our results preview. So back in July, we basically ran through a number of stocks. CSL, we were looking for some weakness into the result, and that did occur, and that provided a good entry for us into that name. The two hospital operators were struggling all year, and the full year results didn't help at all, and we're repositioning our calls there, and Derek will talk about that shortly. ResMed, always difficult to call the quarterly results. We did have a seasonally stronger quarter that we were reporting on. However, given the mix of product, we did see some weakness in that name. Again, that did provide us a really good entry point into that stock around the low $9 mark, and then we have seen a very strong rally in ResMed. Again, we've got some interesting insights into that name about the longer term and how that company is positioning itself into the digital market. Certec's always been a volatile stock, and we're continuing to move our recommendations around on that. Nanosonics also had been very disappointing, and what we were looking for was some commentary into 2018, which we got. And after some initial weakness, we did see that share price recover nicely. Aged care, always been difficult this year. And again, we were looking for some guidance from the companies in respect of 2018, showing some growth. They didn't provide that, and the share prices got knocked around pretty badly. If I can just move to the next slide and just take you to the last 3 dot points, I'll quickly run through them. So Nanosonics, as I said, that share price recovered after the company told us that they were investing heavily into R&D, so taking their $9 million spend up to $15 million, and over the next 2 years, they'll bring 2 new products to market. So the market really appreciated that. We saw the share price recover and around the 260, 270 mark. Really like the long-term outlook for Nanosonics, so happy to keep continuing to buy that story. The aged care operators, as I said, they got hit pretty badly after they came out and said that their earnings weren't growing, in fact going backwards for 2018. Last night we had a major report come out that was tabled in Parliament. David Tune provided an overview of the sector and some potential changes coming through, or some recommended changes. In terms of what we can establish for the aged care guys, it appears that there shouldn't be too much impact. A lot of it had been well flagged, but essentially there'll be more means testing and greater emphasis on home care packages. So trying to keep people at home for longer and provide some funding in that respect. So we'll get some more detail out on that. At the current share prices, the aged care operators are yielding around 5%. I tend to think that's going to support them, despite the fact that their earnings for 18 are looking pretty weak. We also mentioned a number of the emerging healthcare names. I put a slide up in July. We mentioned 9 names. 3 of them have disappointed. 6 are doing well, or at least holding. We are particularly interested in the digital healthcare space. I'll just point you to Volpara and MediBio as 2 names that look really interesting. And we are reviewing our coverage list. And to that end, IDT Australia and Admetus, we are recommending that investors move out of those 2 names. I'll just hand down to Derek just to run through some of the major stocks and how we've repositioned some of our calls.
Yeah, great. And good morning, everybody. And thank you, Scott. Yeah, so what do we like across the large cap healthcare space? So I'll say top of the pops for us right now is Ansell. Now, this really rubber glove and safety manufacturing company isn't very widely held, across the network. But I would actually say that you should do a little bit more work in this name. I think you'll be nicely rewarded. Sure, it did sell its sexual wellness division for $600 million last May. This drove 15% of its profit, but I wouldn't say that this is a company that's lacking any mojo. I think it's actually a very interesting company right now, and I'll tell you why. It's quite unloved, it's unheld, but it's a cyclical. It's now a pure play industrial name, and it kind of playing into the thematic of the cyclical recovery across the globe is what we're seeing. But also all you're seeing is really conservative guidance, we believe, and companies really growing their top line, really good organic growth, really above market. You have a solid cash flow generating business here. It's putting up about an 8% cash flow yield on that and about 95% cash conversion. So a really good way to turn around cash in this business. And it's returning about half this capital from that $600 million divestment as far into capital management, giving about, as I said, half of it back to shareholders in the form of a buyback. That's going to drive 10% accretion into the next couple of years. And they're actually putting through also costs out. They're going to save at least 10% of their profit before tax into 2020. So everything we like to look at and see there. The outlook as far as profit looks really strong, really solid. Looking for fiscal 18 at 10 to 22% EPS growth. Really believe on our estimates that earnings momentum can be sustained. We have a 3-year compounded annual growth rate in the double digits. That's not bad for an industrial company that really trades at a market multiple and a dividend yield of 2.5%. So I would say get your gloves on. We're buyers here of Ansell. Moving on to CSL, more or less an opportunistic dip buyer, I would say, for CSL. As Scotty pointed out, it's been kind of a roller coaster ride outside of earnings, which they missed, disappointed in their outlook statement. That sent the stock down 5%. Everyone bought the dip as we thought, and the stock is now up 5% since that time. But at these levels, I'd be holding some dry powder here. And they're about 5% off of our 138 price target. Really it trades on 26 times forward earnings. That looks a little toppy to me. And this year is really a reinvestment year for CSL. It's not really a capital management year. So more CapEx, less capital management. But that said, we really see solid growth for this company. Really all their products are doing quite well. They're life-saving drugs, as you guys would remember. And I would view their guidance as quite conservative. So net, looking to buy the dips, as I said, 120, 125 is a range that I'll look to accumulate for CSL. Jumping really quickly into the ER, where we find the healthcare operators, both Ramsay and Healthscope. For Ramsay, the stock tried to replicate what CSL I just told you did. It sold off on the outlook statement, which disappointed. Investors bought the dip, but they have been sadly disappointed ever since, and we did pull it back to a hold. What the problem here is that the domestic business is going well. However, it's 50% of the profit of this company. The rest of the world is going backwards. That's the other remaining half. In the UK and France are really seeing really strong tariff cuts. That's pricing down deflation, as well as labor cost increases and uncertainty, of course, in the France market as well. So really the market's trying to digest if the base business can support the rest of the world into this year. It's going to be a hard struggle. So I've always said that, Ramsay's always been one to raise and beat. Really consistency is what you're paying for Ramsay. Double-digit growth this year is going to be a little more difficult for them for the reasons I just enunciated. So we're looking for, this stock to tread water near term. However, the stock has sold off quite dramatically. It's trading at 22 times our forward estimates. That is actually in line with its broader multiple. If I pull out the stock price for that multiple, it'd be around $62. If you can pick this stock up around there, and it's not that far from it right now, on a medium, longer term view, it looks like good buying for me. Now turning quickly to Healthscope, and as I said before, there's a lot of near-term known unknowns. The new CEO, you have uncertainty with the regulatory environment with a lot of government reviews. You have a sluggish utilization environment. The guidance, of course, disappointed, calling for flat growth year over year. So really the near-term risk remains high, and I've said before, it has more hair on it than Bigfoot. But I'll remind you guys, Bigfoot doesn't exist as far as I know. So, you look at this, it's contrasted against really strong sequential momentum in this business. So I saw half over half. The completed brownfield projects, and recall that this is driving a third of their profit. Those are growing 2 times above the market rate, which is good to see there. So really nothing changing our long-term, medium-term view. And of course, the fundamentals, us growing and graying, as I always said, you can't really change that at all, unfortunately. So that's really underpinning this business as well. Stock's trading at 14 times, 1.4, forward multiple, healthcare name. Oh, ouch. Ooh, 10% below the market multiple, 35% below Ramsay. Yeah, looks really cheap. Medium, longer term view. As I said, near term, it's a little bit bumpy. We'll turn now really to medical device. ResMed, Scotty pointed out too. This company is interesting. It's going through a little transition for me. So this was a historical, typical manufacturer and distributor of medical devices to treat what's called sleep disordered breathing. Now, this is a disorder that affects 1 in 4 people, as well as respiratory diseases and disorders. It's transforming really into this leader in cloud-based connectivity and software, digital health analytics. I know it's a mouthful, but it's a very interesting moving piece, and it's really about connected care. It's really about quality outcomes and saving the payers, the government, money. That's all what it's about right now, as far as in healthcare is concerned. So definitely an interesting space to be in. They are a market leader in this space, believe it or not. And it's really interesting for us to watch the chess pieces in this game kind of come out, because maybe ResMed won't be around in a couple of years, maybe next year, who the heck knows. So we still remain buyers of ResMed. And finally, I'll move to Certex, as Scott said. A little bit of moving feast here. We did pull it back to a hold as of yesterday. We did buy this thing back in May, put it to an ad, and wrote it up about 50%, so took some profit off the table there. I think it's just getting too hard. You have increased competition. You have an overhang of their legal battles, and you have a new CEO that has yet to enunciate what exactly he's going to do strategy-wise to drive this company forward and to grow his top line. Now, he told me he's supposed to come out and say this in November, but listen, at this level, I don't have time to wait anymore. Like I said, I pulled it back, locked in some profit here. It's kind of in a too hard basket. Actually, I classified it as watchful waiting, waiting to see what he does. Even though it looks attractive from a 60,000 foot level, trading below a market multiple and a forward earnings aspect, I have no confidence at all in my forward earnings estimates, and I don't think consensus does as well. So like I said, right now, locking in some profit, watch that company. It could be interesting, but who the heck knows as far as what he's going to come out, the new CEO, and say.